You want to borrow $50,000. No bank application, no credit check, no waiting for approval. And the craziest part, the money you borrow keeps earning interest and dividends the entire time you are using it. That is not a sales pitch. That is a contractual mechanism built into a properly designed infinite banking policy. In this video, I'm going to walk you through exactly how a policy loan works, with real numbers, start to finish. You will see what happens to your cash value, what the loan actually costs you, and the rule for using this tool correctly. No bank required. Let's get into it. Let's start with where the money actually comes from, because most people get this wrong. When you take a policy loan, the money does not come out of your cash value. It comes from the insurance company's general account. Your cash value simply collateralizes the loan. Think of it like the security backing the loan, not the source of it. That means your cash value stays exactly where it is. It keeps earning guaranteed interest. It keeps receiving dividends. It does not stop growing just because you took a loan against it. Here is something most people do not know. You have a contractual right to this loan. It is called the first right of refusal. The insurance company cannot deny you. They cannot run your credit. They cannot ask what the money is for. The maximum you can typically borrow is between 95 and 99% of your unencumbered cash value, meaning the portion not already backing another loan. That is the entire mechanism. Now let's put real numbers behind it. Diane owns a physical therapy practice. Her IBC policy has a cash value of $200,000. She needs $50,000 to purchase new equipment for her practice. Here is exactly what happens. Day one, she requests a $50,000 policy loan. Within days, the funds clear into her account. No credit application, no collateral paperwork beyond the policy itself. What happened to her cash value? It stayed at $200,000. It is still collateralizing the loan, but it's still fully hers. It's still earning her dividend rate, which in this illustration is 5%. By her policy anniversary, 1 year later, her cash value has grown by roughly $10,000. That growth happened whether she took the loan or not. Meanwhile, the insurance company charged her simple interest on the $50,000 loan, in this case also 5%, that is $2,500 due at her anniversary date. So here is the full picture. Her cash value grew by $10,000. Her loan cost her $2,500 in interest. She is $7,500 ahead, and she still has the $50,000 of equipment generating revenue in her practice. That is what we mean when we say your money works in two places at once. Now, I have to give you the warning that comes with this power. If you take the maximum loan available, you may not have enough cash value left to cover the interest payment when your anniversary date arrives. If that happens and you do not pay the interest out of pocket, the insurance company simply adds the interest to your loan balance. Now you're paying interest on top of interest. If you are not careful, that balance can grow out of control. The fix is simple. Do not borrow against 100% of your cash value. And the best way to increase how much you have available is to direct as much premium as possible into your paid-up additions rider. The more cash value you build, the more breathing room you have every time you borrow. So when should you actually take a policy loan versus paying cash? There are three good reasons to borrow: a lifestyle necessity, repairs, maintenance, or replacement cost that increase your future production or revenue, a debt reduction, paying off a higher interest loan and increasing your net worth in the process, and an investment, something that appreciates and can be sold later for a profit. Here is what you should never do. Use your policy loan for everyday living expenses. Food, gasoline, utility bills. Your IBC is not an ATM. Treat it like the banking system it is, not a checking account.
I want to share a story that illustrates the second rule Pedro just mentioned, debt reduction. A client came to us carrying $30,000 in credit card debt at an interest rate of over 22%. Every month, most of her payment was going straight to interest, barely touching the principal. She had an IBC policy with enough cash value to take a $30,000 policy loan at 5%. She paid off the credit card in a single transaction. Her new effective rate dropped from over 22% to 5%, and the interest now goes back into her own policy, not a credit card company's pocket. That is debt reduction done right. She did not eliminate debt. She relocated it to a place where she controls the terms.
That is exactly how a policy loan works. Real numbers, start to finish, no bank required. If you want to go deeper on everything we covered today, download our free guide, Policy Loans, the one financial move that lets your money work in two places at once. The link is in the description below. And if you have not yet read how to optimize the cash value your infinite banking policy, that is the natural next step once your policy is up and running. If you are between the ages of 30 and 55 with a gross family income of $150,000 or more, visit infinitebankingsimplified.com to book your complimentary strategy call. Every dollar you spend passes through a bank. Make sure it is yours. In the next video, I'm going to show you how to use this exact mechanism to legally turn your two biggest annual expenses, your taxes and your mortgage, into fuel for your policy's cash value.